bring in right now the Gartman Letter editor and publisher, Dennis Gartman. Dennis, good morning.
Good morning.
What do you make of these markets year to date? It has been an unbelievable year for stocks.
That's the only thing that one can say. It's been a truly unbelievable year. I stand stunned by what we've seen. The problem that I find is that people who are neophytes in the market are now all embracing buying equities. I've seen this game played before. I'd be a little concerned, but nonetheless, it is a bull market. It has been a bull market. And you can write this down. This is 45 years of wisdom involved in the markets. It'll continue until it stops.
It will, okay. It'll go up till it doesn't go up anymore, Dennis. But, you know, okay, speaking of the 45 years of experience, let's talk about 1998 to 2000. There's a really good piece in the Wall Street Journal this morning about the fact that there is concern that corporate profits are really lagging behind market performance. Yeah. And I'm wondering if that bothers you, because this is kind of where we were in 1998, and then 2000, you know, pets.com and everything else crashed around the internet bubble. How do you feel?
It is disconcerting to see stocks racing so far ahead of earnings. Earnings have to catch up. Earnings probably shall catch up, but I suspect that earnings will catch up as share prices over the course of the next year actually moderate or come down just a little bit. That's how that difference will resolve itself. But it is disconcerting to see stock prices up 28% and earnings barely higher for the year. That's not sustainable. One of these things has to narrow, and probably you'll see, as I said, you shall see both of them narrow.
Dennis, hi, James Freeman here at the Wall Street Journal. I wanted to examine this sort of 2000 analogy a bit. We obviously saw kind of a reality check this year on some of the high-flying tech companies that do not have real earnings. As you look now across the broad market, does it look to you like 1999 or not nearly that extreme in terms of valuations?
Well, it's not nearly as extreme, but it does have, the market does seem awfully similar. What bothered me this year more than anything is the lunacy, the stupidity, the extremity of WeWork. I mean, the fact that we almost had a true scam brought upon the American public. Thankfully, the Wall Street Journal did a very good job of exposing what was going on there at the time and the silliness involved in it. Those are the types of things that happen at market peaks. Doesn't mean that the market is peaking right now. Doesn't mean it can't continue to go higher. As I've always said in my newsletter, markets can remain illogical far longer than you or I can remain solvent. But we do see too many similarities between now and what happened in 2000 at the end of the last decade, and it's very disconcerting to me, to say the very least.
It was the technology story, and you know that's kind of goes back to our conversation a couple of moments ago, because you know you had these technology companies, these internet companies. Nobody knew what these companies did. There was no way to prove that they were actually, most of them weren't making money, and then investors bought in. Do you worry? Like, we're looking at the NASDAQ right now. We're about to have another, like, if we hold up right now our 10th consecutive close on the NASDAQ, yeah. We haven't seen action like this since 1997.
Well, it is dismaying. It is disconcerting. And it is, as I said earlier, it's reminiscent of what we saw at the end of the last century, and we've seen it in 2006 and 7 and 8. It is bothersome to me. The fact that WeWork was called a high-tech company is still amazing to me. It was a real estate company more than anything else, and yet we try to hide it as being some high-tech. Uber is talked about as being some high-tech company. It's really just a transportation company. And the fact that we try to hide everything under the dominion of being high-tech is bothersome. It shouldn't be that way. But nonetheless, again, markets can remain illogical.
Hi, Dennis. John Lonsky of Moody's Analytics. My question is the following.
John.
Nice to see you. My question is, you know, economists, the consensus view of economists is that the U.S. economy is going to slow from 2.3% growth this year to something under 2% in 2020. Yet at the same time, the consensus view of equity analysts has an acceleration of S&P 500 revenues from roughly 3.5% to 3.8% in 2019 up to about 5.5% in 2020. How do you square these differences?
You can't. It's not squareable. The two cannot live. I mean, it's really not squareable. The two cannot live at the same time. But we now have a market where bullish news is bullish for the market, and bearish news is bullish for the market. It matters not at this point, and that's the illogic of what's going on. Sooner or later, we shall have a bear market. There's not a question about that, and when we do it, it's going to be a 25 or 30% correction. It'll happen when it happens.
And I think it's important.
Can we square?
Go ahead.
Go ahead.
You know, I think it's important to note that one of the reasons why the market could shrug off subpar earnings for 2019 is because of the deep drop by interest rates. Fed funds came down from, 2.38 to 1.63. 10-year Treasury yield was off sharply. And moreover, corporate bond yields, my goodness, the junk bond yield is down by, I think, 2 to 2.5 percentage points from where it was year-end 2018.
Well, thank goodness for that change in junk bonds. The only positions that I have on in my retirement account, and I'm getting ready to retire at the end of the month, are basically corporate debt and junk bonds that have had a wonderful run in the last 45 to 50 days. So, you know, hooray for that. But am I going to expose myself aggressively to the equities market at this point? No, not hardly.
Dennis, real quick, we got initial jobless claims for the week. They fell by 13,000 in the week ending December 21st. We're now at 222,000, which is still a really healthy job market. But my question is, what does this do to companies in 2020? If we still have this incredibly low unemployment rate, wages are going to have to go up. Isn't that going to eat into profits?
One would think, wouldn't one? I mean, it would only seem logical. The jobless claims at 222 is exactly as expected. When I wrote this morning, I expected to see 222 to 223. Yeah. It's exactly what we got. That's been the anchor point. But you cannot continue to have this sort of low level of unemployment, this high level of employment, without having wage increases, and we're going to start seeing that this year. It can't be any other way other than that.
Dennis Gartman, I'm sorry to hear you're retiring. You're probably not,
well,
but I am.
No, actually, I'm looking forward to it. The fellows that I used to be able to beat on the golf course have all retired 3 years ago, and I have to be able to catch up with them and beat them back again. So, but I'm not going to be retiring completely.
All right.
I'm just going to be writing a bi-weekly and that sort of thing. But getting up at 1 o'clock every morning, that's done.
Oh, all right. I hear you on that one. Actually, golf sounds more fun. Dennis Gartman, thank you very much for being here. It's good to see you.